Hi everyone, this is Mike Kramer of Mott Capital. Today is Tuesday, February 13th, and it's around 6 p.m. New York time. So today here in the U.S., we got the hotter than expected CPI report, which came in at 0.3% versus expectations for 0.2. Core came in at 0.4 versus expectations of 0.3. CPI year over year came in at 3.1 versus a 2.9, and ex-food and energy came in at 3.9 versus 3.7. Then tomorrow we're going to get PPI revisions, and then on Thursday we're looking for retail sales. These are expected to come in at negative 0.2. Last month's reading was 0.6. Ex-auto is expected to be 0.2 versus last month's 0.4. Retail sales ex-auto and gas expected to be 0.2 versus 0.6. The control group is expected to be 0.2 versus 0.8. And then we're going to get import prices and export prices as well. So these are very important numbers, especially what's happening in rates today following the hotter than expected CPI report. We had the 10-year rate today move up pretty sharply, almost 14 basis points, and really more importantly, we got up to that level of resistance around 433, 434. That's a level we've been talking about now for a few weeks. It's a level that goes back to October of 2022. It's a level that served as resistance back in August, and when we broke out above it back in September, the 10-year went on a ride higher. So this is an important level that we need to be very mindful of and be very careful with, because the next level of resistance after 435 likely comes somewhere around the 450 area, right in this zone. Clearly, we've already broken the downtrend. Clearly, the momentum has shifted from lower to higher. It's just a matter of whether or not we're going to get above resistance. If you're going to get economic data tomorrow and Thursday, hotter than expected, which given that CPI came in hotter than expected, and given that retail sales are priced in nominal terms, it's possible here that you do get a hotter than expected retail sales number. But again, we'll have to wait and see what the data is. When we swing over to the 2-year yield, that also had a pretty big move today, rising by almost 18 basis points. We've broken the downtrend in the 2-year. RSI momentum clearly going higher. It looks like our real next level of resistance doesn't come somewhere to around 473 or so. And again, these movements in the 2 and the 10 are really important because the market has pretty much priced in, a scenario where the Fed's going to be aggressively cutting rates, although that seemed to change a little bit after today. And again, it looked like there was a potential for some sort of, inverse head and shoulders pattern forming. That seems to be playing out. And a return to the origin here would take us back to this 475 area. That's another reason why I'm thinking that we're going to potentially get there. And then, of course, if you were to measure from the base, from the head to the neckline, and then extend out, it's also telling you we're looking at a move back up to around the 475 area. So again, good reason to think that we could get higher, and it's probably just going to take a stronger than expected retail sales number. And it is worth pointing out that when it comes to Friday, we are going to get PPI, which, depending on what the retail sales number is, could take on some extra importance. This obviously had a big effect on the dollar index today, which did break out. It did finally clear this 104.25 area rather notably. And it looks like the next major level of resistance for the DXY doesn't really come until about 105.75. It's not really uncommon sometimes for these big moves down to be treated almost as gaps and for the market to try to refill it and to move back up to resistance. We also saw the dollar strengthen against the euro. We've been talking about the euro weakening now for some time. Today we finally returned to this 107 area. This is a level that we need to watch and be mindful of. The euro's not quite oversold yet. It is getting closer to being oversold, but it's not there yet, at least on a RSI metric. And you can see we're just kind of moving down along the lower Bollinger Band. So I would be looking for support at this 106.95 region. Obviously, if we break that level, we're talking about a move down to 105.5. That would probably be enough to get the euro oversold at that point. Again, it doesn't mean it has to all happen tomorrow, but I think ultimately we're speaking about potential for the euro to get down here if this level breaks. If it holds, then I would look for resistance at the 10-day exponential moving average right here around 107.70 or so. When we move over to the pound, you can see that the pound did break down, and now it came back up. It came back up to resistance. It looks like the pound is getting ready to move lower. You can see the 10-day and 20-day exponential moving averages all showing signs of turning over. And if that's the case, then we're likely to see the pound really start moving lower and potentially down to this 125 area. It's also worth keeping an eye on the yen. The yen is up to that 150 area. We just had some comments coming out just a few minutes ago from the Japan's top currency diplomat, Kanda. Recent yen moves are rapid. Closely watching FX move with a high sense of urgency. Will take appropriate steps on FX as needed, which is because we're up at this 150 area, and this is typically where the government starts to step in and starts to get nervous with the yen being in this 150 area. Now, clearly, it's traded as high as 152 back in the fall. So again, we're going to want to keep an eye on this. It looks like we're getting pretty overbought here on the yen currently, reaching about 70 on the RSI and breaking well above the upper Bollinger Band. So it's entirely possible that you see that the yen move back down to this 145 and 3/4 area, maybe even the 10-day exponential moving average somewhere around 149.50. Meanwhile, I think your resistance level is somewhere right around this 51.70 area, which would be a level of resistance from back here in October and November, and then also with this uptrend that comes off of the base here from March of 2023. So this is something to keep an eye on. When we swing over to the equity indexes, the NASDAQ 100 today fell by about 1.5%. It came right down to the 20-day moving average. And so this was a level where it bounced right off of. If you notice, it closed below the 10-day exponential moving average. Typically, I like to see the index trade below the 10-day for a couple of days to really give us confidence that perhaps there's been a change in trend. To this point, you haven't seen that yet. But again, we did bounce right off the 20-day moving average. So we're going to want to see what happens tomorrow. If you obviously get yields in the dollar strengthening and yields rising, I think that's going to put downward pressure on equities. And there is room really to trade down to this lower Bollinger Band at some point over the next couple of days and weeks. If we look more closely, though, at the structure here, we can see that there was a clear level of support in place with these highs. We clearly gapped below that level of support today. And then, of course, there was also this uptrend off the lows, and we also moved below it and came back up to and tested it. So I think that for tomorrow, in order for the bulls to gain momentum, you're going to need to continue to gap again higher. I think you're going to need to quickly take out 17,650, and potentially that gives you room to move up to 17,713. Maybe that sets up a potential gap fill between now and the end of the week. Anything short of that, I think the momentum has shifted, and we could see some lower prices here, potentially down to 17,350. When we take a look at the Dow was also weaker on the day. Again, the Dow has been sort of the one index that hasn't been doing quite as much, and that's because it doesn't have, let's face it, NVIDIA in it. NVIDIA has obviously been a big driver of the NASDAQ and the S&P 500. So again, this is one of the reasons why I think the Dow has been kind of, not really participating, although it has been going up. It doesn't seem to have the same velocity to it. Here you can see is your level of support. If we were to break lower tomorrow, it could set up a drop to around 37,800. Again, here you can see your straight line rally into the close in the last 45 minutes. It's not uncommon sometimes to see us gap down and take out this low very quickly. That's all going to depend on what the data is at 8:30. You get hot data, you're probably going to gap down below this number and look for 37,800, even with the potential to retrace all the way back down to 37,200, because again, this was the base of that flag pattern that we had talked about a couple of weeks ago, and so there's a chance that this whole thing gets removed from the equation at some point. And then finally with the S&P, today broke out of that rising wedge pattern that looked like it had been forming. We made a pretty good retracement all the way down to the 61.8% level, and that's where we stopped going down, which is sort of an interesting spot. If you're bearish, you really didn't want to see the index stop and bounce there. But at the same time, if you're bullish, you're right, you don't really like this straight line rally into the close. Because again, as we've talked about, sometimes these patterns have a tendency to open right down below the 49, that would be 49.20 in this case. Clearly, if we were to continue to move higher, it does set up a chance for a gap fill at 5,025 as we go into OPEX. That is one other thing that's going on this week. Obviously, you have monthly OPEX on Friday, and there's a lot of open calls and puts up at the 5,000 area. So that area could act as a bit of a magnet over the next few days, drawing the market back up, especially for people that may have been in the money on their calls that are no longer in the money, and they may want to try to get the market moving up back to those levels. And I think that's really all we have for today. I hope you find this helpful, and we'll talk to you again soon. Bye.